Hi, it's Bob Hoopshire, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Vetify. Uncertainty around the direction of inflation, interest rates, and the U.S. economy will continue to drive market volatility. Doug Wolff, the CEO of Security Benefit, a leader in the U.S. retirement industry, is my guest today to offer valuable insight on how to navigate this landscape for the remainder of 2023 and beyond. The traditional 60-40 asset mix is facing several challenges due to that volatility. Both stocks and bonds were battered in 2022. While both have come back a little bit this year, the uncertainty makes it difficult to optimize portfolio allocations. Doug will discuss bond alternatives like fixed rate annuities to diversify and de-risk client portfolios. Doug is the CEO of Security Benefit and serves as the chairman of the board for Everly, the company's life insurance subsidiary. He brings more than 35 years of industry experience and specialized expertise. So, Doug, tell me a little bit about your career path, what led you to Security Benefit, and how you became CEO.
Sure, Bob, and thank you for having me. Appreciate being here, and thank your audience for listening in. I started my career actually at Ernst & Young on the insurance consulting side. I was there for about 8 years. Then I was at Allstate Insurance Company on the product development side for about 6 years, and I've been at Security Benefit for over 21 years now. Joined for a product development role, then moved up to be president of the life company, or of the manufacturing entity, as we call it. We split between manufacturing and distribution. I was in charge of that for about 8 or 9 years, which involved the product, actuarial, operations, and technology, all the back office part of the organization, and then moved into the CEO role last July. And Bob, while I have a technical background, I'm an actuary by background. My real passion is in working and connecting the top line to the bottom line. So figuring out solutions that help mitigate risk for policyholders in our company, and pricing those solutions properly while working closely with the marketing and distribution teams to make sure that the solutions are not only artistic successes, but hopefully are commercial successes as well.
Well, I want to talk about some of those solutions, but first, I have the honor of speaking with a CEO of a prestigious company. Security Benefit is a 125-year-old company. It has nearly 500 or $50 billion in assets under management, and I know it also has deep roots in your local community, Topeka, Kansas. Tell me a little bit more about the company and its competitive positioning.
Sure, Bob. Yeah, we're actually 131 years old, so even a little older, than you said there. We were started in 1892 in the back of a small drugstore here in Topeka, Kansas, where 11 men came together with $11 to create one of the first insurance funds for those who otherwise couldn't afford it. We were known then as the Knights and Ladies of Security, and built a national reputation for ingenuity and philanthropy. And really, our strategic focus there was built on the belief that everyone deserves an opportunity to achieve financial well-being. It continues to be our strategic focus and our legacy, and it's one we're proud of and determined to preserve. We attribute our longevity to a nimble business model, the unparalleled importance we place on our partnerships, first and foremost with, of course, our own employees, but also with our outside customers and policyholders, our network of independent financial professionals that sits down with the customers and presents our products, and the communities that we live and work in, with our main home office being, as you noted, here in Topeka, Kansas.
I'm curious how you have navigated the period of rising interest rates over the last several years. Obviously, you're in the insurance and annuity business. It's a highly dependent on interest rates and the term structure. Tell me how the last few years have been.
Yeah, Bob. Actually, we've fared exceptionally well over the last couple of years. Security benefit, we had record earnings in 2021 and then followed that up with a very strong year as well in 2022. And we closed 2022 with record levels of capital and surplus. Really, a few specific items I think have helped us perform so well over the past couple of years in this, as you pointed out, challenging interest rate environment and volatile interest rate environment. One is that there seems to be more demand than ever for safer ways to invest, to save for retirement or long term goals. And with the economic volatility, stock market volatility, interest rate rising and moving quickly, people living longer, pension plans being less and less available, that's really led to a surge in demand for safer vehicles like fixed and fixed indexed annuities. And this has helped security benefits, helped the whole industry, but specifically security benefit to record sales month over month. So we started setting our monthly record sales in the late third, early fourth quarter of 2022. And each month since then has been a record number for security benefit through the first 4 or 5 months here in 2023. So pretty exciting to see our products and services perform the way they have and be in demand the way they have here in this environment. And then I'd also point to our investment strategy. Our investment strategy behind our general account tends to be a little differentiated from a lot of our insurance company competitors. And one of the ways it's differentiated is that we really like the floating rate assets and asset classes. So about 30% of our asset portfolio, the loans are based on a floating rate as opposed to a fixed rate, which means as short-term interest rates have risen 400 or 500 basis points here over the last 18 months, essentially on those loans, our portfolio yield rate has also gone up by that 400 or 500 basis points, at least on that 30% or so of our portfolio. And just in general, our assets tend to be quite a bit shorter, both in terms of weighted average life and in terms of effective duration. Our assets are quite a bit shorter than our liabilities. So as you've read about some of the headlines and the challenges for things like the regional banks, we actually have a portfolio that's structured exactly the opposite. And those regional banks that were challenged and still are tended to have assets that were a fair amount longer than their liabilities. With assets shorter than liabilities like we have, it means that as interest rates have gone up, we're able to reinvest and get better rates of return on the right side of our balance sheet.
Well, thank you. That's fascinating. I could ask many more questions about your business, but I want to come back to the point you made about the need for safety among consumers in their financial products. So, how should advisors prepare for the uncertain economic conditions that are likely to persist through the remainder of this year?
Yeah, so based on the trends that we've observed this year in the environment, including increasing interest rate and stock market volatility, relatively high inflation, higher inflation than we've seen in decades. I think it's important for financial professionals to consider investment options that provide some stability and provide some risk mitigation to their clients' portfolios. Um, in particular, in the business that we're in, one of our more popular products that we offer are, fixed type annuities, which include multi-year guarantee annuities with a fixed rate called MIGAs. Also include fixed indexed annuities with principal protection. Uh, and really, I think of those products as having all weather protection in this volatile rate environment. And by that, I mean, if you position, some of the more conservative part of your client's portfolio in these vehicles, if rates continue to go up You really avoid the market value losses that other fixed income vehicles might suffer, like with bond funds or something like that you probably saw if you were using those with your client's portfolio over the last 18 months. If rates remain stable at the relatively high level that they're at, you've put your client in vehicles that have high guaranteed rates or high hedge budgets that can allow some real tax deferred accumulation potential for your clients. And if rates should go down, you'll be happy that you've put your clients' money to work in this higher rate environment and got them, better guarantees and better rates. So it's really kind of an all-weather protection that annuities can provide for your client. And I like to think of financial professionals really are in the business of preparation and not prediction. And I believe these fixed annuities and fixed indexed annuities are really financial products that can help financial professionals with proper preparation for their clients.
I like that preparation and not prediction. I might steal that from you and use it in an article that I write some point.
Excellent.
So let's go back to 2022. Stocks were down, I think, a little more than 18%. The Bloomberg Ag was down about 13%. So it was a double barrel disaster last year for both of the major asset classes. This year, stocks are up about 14%, and I think bonds are up maybe 4%. How has the performance of stocks and bonds last year and this year challenged traditional investment strategies like the traditional 60/40 portfolio?
Well, I think you laid it out very nicely, Bob. To have both sides of that 60/40 portfolio be challenged the way they were in 2022 really uh, puts the concept of diversification or what we think of as diversification, into being challenged. All right. Don't get me wrong. I still believe that diversification is very important going forward. Um, but I think as you look at the more conservative parts of your clients' portfolios in particular, that 40%, depending on what vehicles you were using there, you might have got hurt. Your clients might have got hurt worse uh, than if they used other vehicles. So again, I go back to the fact that with something like a bond fund, particularly a bond fund that had any kind of duration or length to it, um, your clients probably really suffered some market value loss in a year like 2022 when rates are going up. Whereas in vehicles like annuities and fixed rate annuities, you wouldn't have clients that suffer that type of a loss. So um, I think that can be important, again, kind of mixing up and making sure that you're not only diversified between the 60 and the 40, but on both sides of the 60 and the 40, on the equity side and on the fixed income side, you diversify amongst vehicles there as well. And the other thing I'd mention is I know after a year like 2022, I think for a lot of financial professionals, it's sometimes difficult to get clients to take any market exposure or any equity risk at all. But we all know that in most portfolios that have any kind of time horizon, there should be exposure to that side of the equation as well. And so something like a fixed indexed annuity, which can give clients some market exposure and some upside potential, but still maintain kind of principal and downside protection, that can be a nice way to help ease your clients, back into taking a little bit of risk so they can get some equity exposure in their portfolio.
On July 24th, VettaFi will host a fixed income symposium. Hear from industry leaders, get 3 hours of CE credits, and learn how to unpack the complex and exciting fixed income space. Register today at etftrends.com/webcast/fixed-income-symposium.
So, one of the themes that is prevalent among advisors is what are the replacements that someone can use for bonds in their portfolio, particularly among those who fear that rates may go back up. What alternative options should advisors consider for the fixed income portion of their portfolios?
So, as I've mentioned earlier, right, I think the fixed portion of the annuity class is an important alternative that financial advisors should consider for their client portfolios. Everything from the multi-year guarantee or MIGA that gives the client a fixed rate guaranteed for a certain period of time to fixed indexed annuities and registered index linked annuities that you're hearing a lot more about these days, RILAs. So FIAs and RILAs that in addition to a fixed option, can give the clients a compelling combination of some accumulation potential, tax deferral, some exposure to equity indexes, yet you have the principal protection. And to the extent that you have some equity gain from prior years in those indexes, that gets locked in on a typically a year by year or an every 2 year basis.
When you look at fixed index annuities and even RILAs, you mentioned that they have some downside protection. How extensive is that protection and how does it work?
So it depends on the vehicle. Typically, with fixed indexed annuities, that downside protection would mean that the account value of the clients uh, will be potentially ratcheted up each year if those index strategies and the parameters perform to a positive return. But if there's a negative return in the market, like there was in 2022, then typically that account value will stay level. It won't go down year over year. With registered index linked annuities, there may be a bit more upside on the equity side than there is with a fixed indexed annuity. But the trade off is the client typically takes some downside risk. So, for example, it might be if it's based on the S&P 500, it might be that the client can get a return up to, let's say, a 15% cap. So if the market does anywhere from 0 to 15%, the client would get that return. If it returns more than 15%, they'd get the 15. However, then the client typically has to take some downside. So in the example I just gave, the client may take up to 10% of the downside return as their risk. So if the market was down 8%, the client would lose 8% on their account value. If the market was down, double digits like it was in 2022, the client's downside risk would be limited to that 10% loss on their account value. But of course, each product that's out there is a little bit different, maybe based on different indices, may have different kind of upside and downside limits. So that's where consulting with your financial professional makes sense.
And we've also had a fair number of articles about RILAs and their benefits that we published. They are a very appealing product for many advisors. Are there questions that advisors are not thinking enough about when they're advising their clients, particularly when you look at environment that's likely to persist this year going into next year?
So interesting. One of the things that I didn't seem to hear as much about, I think, over the last 12 to 24 months versus maybe a little bit earlier was taxes. I think with a rationale that when there's lost years, maybe taxes aren't quite as much of a concern for end clients. However, again, I think financial advisors, they're in the business of preparation and preparing their clients, still need to be thinking quite a bit about taxes, about the challenge of relatively high tax rates, about the thought that probably if you look forward, I would guess that tax rates are going to go up and not down. And so using certain vehicles, annuities are one of them, that have tax deferral and that put kind of the timing of when your client is going to exercise and have to pay those taxes into their control. I think that can be very important and a component of planning that advisors should always be thinking about on behalf of their clients.
So coming back to security benefit, when you look at your business and you look at it going into this year, next year, and beyond, what do you see as the greatest opportunities and the challenges?
So on the opportunity side, Bob, I certainly the ongoing and renewed interest in safer investment vehicles, which tends to typically pop up when there's equity market challenges and investors and people realize that markets can go down and not just up, creates this renewed interest in safe ways to invest for the long term. I think that's been a huge opportunity for our industry and certainly for security benefit. From security benefit standpoint, I would also say a real opportunity for us is to continue utilizing technology and new technology tools and data to better continue bettering our service for our customers, both the end policyholders and the financial intermediaries that utilize our products and services with their end customer. And then, of course, another opportunity, one that I think we've been particularly successful at for security benefit for the last 10 plus years and need to be going forward is to continue to innovate on financial products. So coming up with new ways to bring institutional investment strategies and institutional risk mitigation solutions to the retail customer and the financial professionals that utilize our products with the end customer. From a challenging standpoint, there's no question that interest rate volatility and the speed at which rates seem to go up and down on almost a weekly or daily basis this day is a challenge. It's a challenge for everyone trying to, invest and save for the long term, and it certainly can be a challenge for security benefit as well. I also think for individuals that are trying to save and plan for retirement, particularly for those close to their retirement date or those that have recently retirement, inflation is a big challenge. And particularly for those that have recently retired, if you think about it, for the last 10 to 15 years, to the extent that they've been able to save up and invest, they've typically had to do that at relatively low interest rates because we were at historically low interest rates just a couple of years ago. And we were there for, about a decade. So they've had to save at low interest rates, but they're facing much higher inflation. And so as people live longer in their retirement, and as an example, if 25 years go by, if inflation is at 2%, I think clients have about maybe 60% buying power that they had in the year that they retired. If that inflation number is closer to the 5%, which is what we've seen recently, I think clients only have about 30% of the buying power that they had when they entered retirement. So, inflation does seem to be heading in the right direction, but it's certainly a challenge for those entering retirement and getting inflation under control. With the flip side being making sure that you're looking at some of these vehicles to potentially invest in now that there are higher rates to help offset the effect of inflation and buying power in their retirement. That's a challenge.
If there is one key takeaway that you'd like to leave with our audience of advisors about how they should design financial plans that provide reliable income and mitigate against stock and bond market risk and inflation, like you just mentioned, what would that be?
So I think, Bob, it would be really that, diversification is important. Diversifying the portfolio between, depending on risk tolerance and time horizon, between riskier, asset classes like equities and more conservative asset classes like you typically have on the fixed income part. But then the importance of diversifying within both that 60 and 40 portfolio, 40% portfolio. And as I've mentioned several times, within that fixed income part of the portfolio, really making sure that you've looked at and considered something like an annuity, be it a MIGA or a fixed indexed annuity or a RILA that can do well no matter where interest rates go in the future. And that way you've properly diversified the 40% or the less risky portion of a client's portfolio as well. To get back to that mantra, right, it's all about preparation and not prediction. And I think that's important for financial professionals in helping the end client.
Thank you. And we'll include a link in the notes that accompany this podcast to the Security Benefit website. Doug, is there anything else you'd like to add?
Bob, I just want to say, thank you again. Thanks to your audience, and certainly thanks to you, Advisor Perspectives and Verify, for having me on this podcast. It was a pleasure speaking with you again, Bob. Enjoyed it.
You're welcome, and thank you for listening to the Gaining Perspective podcast with Bob Hoopshire, today featuring Doug Wolff of Security Benefit. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on iTunes, Spotify, and Stitcher.